I think we're ready to roll, Xiaolin.
Morning.
Oh.
Yeah, good morning, everyone, or good evening for those in Europe.
I know. Thank you for being patient with us this morning. Obviously, very good afternoon, like Brandon was saying, and good morning to all of you who join us today around the globe. It is my absolute pleasure to welcome you to our highly anticipated webinar, a China Q2 review, insights from on the ground. We're really thrilled to have you with us of this today as we deep dive in one of the world's most dynamic and rapidly evolving market of China. A lot has happened in Q2, a lot of continue to happen in the coming weeks and months. And then today, I'm incredibly honored to be joined by my two distinguished colleagues, our Chief Investment Officer, Brandon, who many of you knows him anyway. The man need no introduction, and our very deeply rooted investment analyst, Henry. Both of them bring a wealth of knowledge and first-hand experience, obviously, to the table, like you always know. In fact, all of us, all three of us, actually recently had, an opportunity to visit China during the last quarter. What we have witnessed was nothing but short of extraordinary things has happening, developing. The scale and the pace of the development happening in China are truly astonishing. So we are really eager to share these insights with you today during today's webinar. Obviously, throughout today's session, we will take you through a comprehensive review of China's second quarter performance, events happened, macro policy impact the market, fundamental opportunities. Obviously, we'll develop or we will discuss all these key developments with you and trends that's emerging, sentiments are, we observed on the ground, so on and so forth. So hopefully that will be, interesting and helpful to your discussion. We always want this to be not a one-way discussion, so your engagement is really important to our webinar. So as always, we encourage you to send in questions to us at info@KraneShares. And throughout the webinar, you have a button at the bottom of the Zoom. If you dial in through Zoom, you can send in your questions from Q&A. And I believe this webinar is also credible. It's one CFP, CMA, and CPD credit available. Just get in touch with us if you shall need it. Okay, let's dive in. Let's go to the next page. For those of you, I bet very few who doesn't know KraneShares. We started our firm about 10, 11 years ago, starting with singular focus on China, but we're really thrilled and blessed to have the opportunity to build upon from China's strategy to methods, to trends and important initiatives around the globe that require China's big commitments. If you turn to the next page, this is a suite of our solutions that is available in US formats and also in UCITS formats. You can see we have a center focus of China focus strategy of the thematic play and core play. We also heavily involved in the bigger themes such as climate. We have probably one of the largest global carbon strategy that is in the United States listed, and also the bunch of uncorrelated strategies in the KFA or KraneShares fund advisor platforms. And we also have themes that requires China's contribution, but it's actually a global play, such as all the strategy on the global basket. So on the next page, want to do a bit of a brief and deep dive, just looking the indices return for this quarter. We know is from second quarter, a lot of things has happened, a lot of eyes on the March events, and then June has hosted a very important events, and then shopping festival of 618. We're going to deep dive of all of that. Macro side of every single events come out or the release from each events has showed nothing but commitments to continue to support the policy in terms of monetary and physical spending. Corporate policy continue to stay very accommodative, as well as the liquidity front has remained very committed. We witnessed the 1 trillion ultra long dated bond get issued in May, and that get oversubscribed by the retail or by institutional domestic investors in China. We continue to see central banks remain very committed to make sure liquidity is sufficient. And both Brandon and me and also Henry made a trip to China for during this quarter. So we literally have a lot to share and to see. Obviously, the number is here. This is the results as of 30th of June. We obviously see a very sharp rebound from end of February, and then we see a bit of retrieve from May, but it's fairly to say any rebound without any retrieve is not sustainable. So we quite see that is a marginally pullback from the peak, but yes, there's a pullback, but safely to see that KWEB, at least of our flagship ETF, has now year-to-date to the positive territory. Some of the headline news impacted strategies such as clean EV and so on and so forth had experienced a bit of headline-driven corrections, but that's really based on some tariff and macro policy driven. So on to the next page. What we'd like to do is Brendan to give you a bit of a deep dive on returns from US and comparisons on the investment opportunities still presents in Chinese equity market. Brendan, off to you.
Yeah, thank you, Jalen. And thank you for all of us joining today. One of the headwinds investing in China is not unique to China. It's certainly not unique to emerging markets, nor investing in non-US equities in general, which is since the global financial crisis low back in March of 2009, US equities until yesterday's close were up 1,001%. Non-US equities, as measured by MSCI's All Country World ex-US, is up not even 1/3 of the S&P 500's 1,001%. All Country World ex-US is up 306%, and emerging markets is up about 243%. So one of the factors that I think our collective travel as we meet our institutional investors globally is we've come to realize that many investors, particularly many global institutions, particularly here in the United States, are heavily overweight US equities after this 15 years of outperformance. And if you think about 15 years is 60 times you open your quarterly statement and see that diversifying in non-US equities hasn't worked. And that's true for institutions because you have to report to your investment committee or your board or your trustees. And we think there's a very significant overweight to US equities from global institutions. Now what's aided and embedded this significant US equity outperformance has been the strong performance of the US dollar. Since it bottomed in 2011, the US dollar index is up 40%. It's actually outperformed every currency globally. So US equities have had a significant tailwind. Now, there is another tailwind at effect, which is the sector composition of the S&P 500 is heavily skewed to growth stocks, particularly growth subsectors within technology and consumer discretionary and communication. Now, a day like today, we're seeing the downside of that as, say, the dollar has actually weakened overnight. And we think if the Federal Reserve does embark on cutting interest rates, it could weaken the dollar, which would only exacerbate the pressure on foreign investors in US equities. So one of our counsel has been, why wouldn't investors take a piece of their significant profits in US equities, as well as areas of outperformance, such as India and Japan? Why wouldn't you just simply take a piece of those profits and put it into inexpensive Chinese equities? And we maintain that counsel and why we believe in that recommendation. Now, one of the effects of this significant US equity outperformance on the next slide is the underweight, not only in non-US equities, but emerging markets, but also particularly in Chinese equities. So some great work from Morgan Stanley's quantitative China analysts on the left-hand side, showing that investment professionals within their mutual funds, if it's a global mandate or emerging markets or Asia, Japan, are very, very underweight Japan. Now, we've seen some of the managers not based in the US curtail a piece of that underweight, but still a very significant underweight. And certainly UBS on the right-hand side also showed that the equity ownership toward Chinese equities actually hit an all-time low earlier this year. And one of our favorite research providers, the Copley Fund Research, has shown also similarly very significant underweight. Earlier this year, actually, one of the largest weights in MSCI's All Country World Index started with the letter C, ended in the letter A, but it wasn't the country with a GDP of 18 trillion. It was the country that starts with a C, ends in an A, with a GDP of 2 trillion. So would you believe Canada became a larger weight than China? But it shows the extent of this movement out of non-US equities, emerging markets, as well as China. Now, part of what this underweight led to on the next slide was that as investors had this underweight to this exposure, in January of this year, we felt what was really a liquidation event. And it's easy in hindsight to say you always buy a liquidation event, but due to some derivative products in both mainland China called snowballs, as well as in Hong Kong, as index levels came down and triggered the auto redemption of these derivative products, it put a lot of selling pressure. But again, due to this underweight to Chinese equities, there was no one there to buy, which led to this very dramatic fall. Now we did see a bounce following that liquidation event, and starting in mid-May, as we got kind of mixed economic data, that rally has kind of come down, it's pulled back. So this has been our counsel, that obviously not all investors can move very quickly to take advantage of this January liquidation event. So for investors that are thinking about, their investment committee or their board or their trustees thinking, we saw this rebound in China, we've seen it come back a bit, should we be buyers? So really what today is about giving some counsel on why we think it's worth just taking a piece of those profits in US tech stocks or Japan or India. Just take a piece, put it into cheap Chinese equity. So let's get into a little bit of our thesis into what we see on the horizon. So really on the next slide, one of the first catalysts that we see is, if we think about this underweight to Chinese equities, it happened in a geographic manner, that many US equity investors went underweight because of Trump and the trade war and the tech war, zero COVID. Many European investors became very concerned following the Russian invasion of Ukraine. I think many investors in Asia were a little bit slower to going neutral or underweight on Chinese equities, because as we'll discuss, when you go to China, visually nothing's changed. But also the importance of China regionally is not going to change. And lastly, we're investors in China themselves. Now the importance of this slide is we can actually track the activity of mainland investors in buying and selling Hong Kong stocks. Every day on hkex.com, you can track this through, it's called the Connect Trading Program. And what this slide shows is the net buying, so this is net of sales, the aggregate purchase of Hong Kong stocks is actually greater than calendar year 2023. So the Chinese are buying Chinese stocks in Hong Kong, as evidenced through the hard data provided by the Hong Kong Stock Exchange. So the Chinese are buying China. Now on the next slide, there's actually we're showing that this southbound buying is mainly skewed to many more growth-oriented stocks. I think that's important. And I think that's true as foreign investors look at buying Chinese stocks in Hong Kong. They're gonna look at the growth stocks, and we've got some good data on why that's the appropriate strategy in our opinion. But we also see another opportunity, which is not all growth stocks are eligible for Southbound Stock Connect. That one of the requirements for eligibility is that your primary listing has to be in Hong Kong. And in just a few weeks' time, we think it's very feasible that Alibaba will announce that it's moved its primary listing from the New York Stock Exchange to the Hong Kong Stock Exchange. Now, the importance of getting that done in August, and we could find that out, their earnings are August 9th, is that for the eligibility for new stocks going into southbound stock exchange happens twice a year, March and September. Now, what would happen? What do we think could happen if Alibaba goes into southbound Stock Connect in September? On the next slide is we can look at one of its peers or arguably rivals, Tencent. Similar to Tencent, Alibaba has a very, very significant presence in China. And we can look at the number of users of its applications to e-commerce websites in comparison to Tencent's WeChat. It's the Facebook of China. But we can then make some comparisons that we know that almost 10% of 10% ownership of stock is actually held in mainland China. So we just did the simple math of what's that 10% versus what would that mean in terms of flows. We can also look at the percent, the dollar value that we know that there's 44 billion of capital invested from mainland China into Tencent shares. So again, currently there's zero in Alibaba. So 10% of Alibaba's almost 200 billion in market cap, it's potentially we would get, obviously 20 billion of inflow. At the same time, if we get the same amount of inflow, we're talking about 44 billion into Alibaba's stock. Obviously there's a big asterisk, a big if. But regardless, we think this is a very significant event that is not on the radar of many investors. And we see this, obviously that's not going to happen overnight. But again, this is a real catalyst coming. Now, another catalyst on the next slide is we mentioned these institutional investors in China buying stocks via southbound Stock Connect, is the companies themselves are buying back stock. And what's interesting is many of these companies had never paid out dividends, had never done stock purchases. And yet, if we look at the buyback yield, the amount of projected stock these companies have said they're going to buy, board approved, it's a very significant percentage of their shares outstanding, as well as if we look at the outright percent that the board has approved, it's a very significant dollar amount. So we think you have Chinese investors buying China, and you have these companies buying their stock. Now there's a unique aspect to the companies within KWEB, and that is on the next slide, is that just about universally, the founder or founders are the CEO or the chairpersons of these companies. So it's not just that these companies are buying back stock. Now, why is that important? Well, one, the founder or founders of these companies, their net worth is in the same stock. Now, the other factor is if these corporate executives felt that China's economy was about to perform poorly, wouldn't they be hoarding cash and not buying back stock? If these companies, if these corporate executives whose net worth is highly invested in the stocks, in the same stock that we hold in KWEB, they felt the corporate prospect of their company was so poor, wouldn't they be hoarding cash and not buying back stock? And yet that is what they're doing. We think this is a very, very important catalyst that these corporate executives are saying, we think our stock is cheap, and they're putting their money where their mouth is by buying back the stock. I just think this is so important. Now, again, that effect doesn't immediately mean the stock goes up. Their companies are buying back a lot of stock. But we do think it's a very important catalyst for investors with medium to long-term time horizons, which in the case of investing in China, you almost need to have. Now another factor that we wanted to address that's come up, and certainly the feedback from our and investors that those of you joining us is we always want to, when we get asked really good questions, we want to be able to share that with our fellow investors. And on the next slide, one of the pushbacks on investing is they say, well, we've seen the U.S. government putting in restrictions on the export of technology to China. Well, one, shouldn't that really weigh on the profits of U.S. technology companies like NVIDIA and Qualcomm? And I mean, if you're that, that would be what you should be most worried about, because China represents such a significant percentage. But again, you have all of this money from in the United States, from outside of the U.S., going into this very, very small number of U.S. tech growth stocks, and it's pushed them up. But it's almost a hypocritical, if you're that worried about the geopolitical, those are the names you'd actually sell, but that's neither. But I think an important aspect is, if you actually look at what these companies are saying, is the companies are basically adapting to what these rules in the road in terms of export technology. And I thought, Baidu, really arguably one of the leading AI plays with their Ernie bot, their large language model. They get no credit for, they get no valuation. But their founder and CEO, Robin Li, actually spoke about in their earnings call that, if the U.S. government restricts us from the very top, very, very small nanometer chips, we can take several of those chips, and basically it equals one high-end chip. So there's been a whole host of ways we've seen the companies in KWEB, and that's certainly something that when I met with Tencent, they had mentioned, and they actually mentioned this in their Q3 2023 earnings readout, that they bought several life cycles worth of chips in advance of the potential for U.S. export restrictions. So business people figure things out, and certainly I think one of the amazing things is that arguably the U.S. government created Apple's worst nightmare, which is a real competitor, by putting such technology export restrictions on Huawei. Huawei had two choices: innovate or die. And lo and behold, they've innovated using homegrown chips and created the first legitimate competitor to an iPhone. And unfortunately, you're seeing that play out in Apple's results in China, that Huawei is doing very well. I mean, this is a very good phone. It's not some cheap knockoff, the Huawei Mate Pro 60 Plus, and it's really weighing on iPhone sales in China. So I think that, so and think about the purpose of today's providing catalysts that we see on the horizon: low investor positioning, mainland investors buying Hong Kong, particularly growth stocks in Hong Kong via Southbound Stock Connect. The companies are buying back stock very significantly. And those companies, the founder is the CEO, the chairperson. And so they have a highly vested interest in seeing those stock prices go up. They think the stock is cheap, they're buying. So I want to talk about, Xiaolin, what are some of the things that we're seeing out of some of the recent government meetings? What are the potential other catalysts that we're seeing from a policy perspective?
Absolutely, Brandon. It's fascinating to hear and compare all these Chinese investment opportunities versus counterparts in US. And obviously this year, we keep a lot of eyes on, particularly after Q1, the GDP data was strong. Q2, it was a bit of a pullback, and all the eyes is on a couple of key questions. One, is the government going to continue to support the economic recovery as they have been from Q1 last year, all the way is already 5-6 quarters consecutively accommodative policy that announced by Chinese policymaker. So this quarter particularly, we put a lot of emphasis or focus on what is happening this month. Obviously, the third plenum is happened already in June. That we have a key rate, and literally we were not joking. We were going through the Chinese report, English reports. In many ways, we can is 17,000 of words, like Brandon mentioned them in the CLN as well, and we mentioned here. We catch, or everybody, the research who is keep an eye on these events was trying to catch the keywords. Obviously, the housing for living is removed completely from the discussion. It probably shows some signs of confirmation and reconfirmation of now they're putting a floor into the real estate market now. Okay, the put being activated means now they will do everything they can. Think market should smoothing out and stabilize from here in the real estate market. You see they have cut multiple rounds of lending rates, mortgage rates, down payment, and remove restrictions from tier 1, tier 2 cities to allow people to buy. So this is one of the key takeaway from the third plenum meeting happened a few weeks ago. So this is one of our key takeaways. I literally read through the Chinese reports, highlights, and on social media on when they reported on the conference, so on and so forth. It's, to me, usually this kind of meeting is really on the long term, where we should focus on the next 5 year, where strategically we should be focusing. But I think this year, some changes here is they also address a bit of the near-term concerns, where the consumers weakness, how they're going to address that, and so on and so forth. Like liquidity will continue to stay accommodative. They will target and aim to achieve the 5% target. So all these things is really for the investors to feel reassured that near term is also on the focus of the Chinese policymaker to make sure they deliver that as well. Obviously, I take it quite positive from this meeting takeaways, because I think they have strike really a balanced tone on focusing near-term challenges and how they're going to address long-term opportunities for China to continue to focus on very clearly, both internationally or outside of China and domestically, how they're going to achieve that. Couple of areas they mentioned, which one for most important is consumption. Consumer is 40% China's GDP. That's going to continue to be. They find a way to help the household have more to spend. You can say how. You probably see the CLN notes Brandon sent out a few days ago is now the PBOC cut the lending rates again. So it's 10 basis points. A lot of us live here in the outside of China. Our mortgage fixed for 2 years and 30 years. That's the rate. Unless you go remortgage, your mortgage monthly payment doesn't change. But in China, slightly different. If your lending rate changed, that affects straight away. Okay, so you probably for ordinary household, you probably have a few hundreds, renminbi straight away to spare and not need to pay for the mortgage anymore. So that kind of impact actually quite immediate injection of monthly spends. That's one. And then on the long term, obviously, this is also something I want to share is June when I went to Davos. This year, summer Davos was held in Dalian, is a northeast city in China. And then I had the pleasure to listen to Premier Lee's open speech for 20 minutes. Literally, it's very clear message. He said 3 industries, and this is repeated in the same third plenum meeting a few weeks ago, is artificial intelligence, AI, and the green, clean technology area. And the third one is healthcare tech. Those 3 industries, he said he'll be very amazed and will be supportive and definitely confident to see those industries in China will be $1 trillion worth industry in China in the coming years. So you can tell they're very focused on developing those 3. I think in this meeting, they also emphasize long-term, they focusing on urbanization and modernization of the society. That's a key takeaway. And the second is they're really focusing on those 3 areas we just discussed continuously for that to be leading and self-innovating and progress forward, period, the end, full speed ahead. They also address quite a lot of the long-term challenges, how they're going to move the retirement age, which we have discussed in some of the individual meetings with all of you on how China is going to deal with this. Apparently, you know, women can retire at age 50 to 55. If they expand it for 5 years, you probably wouldn't be too mad about them. But ours, like in the UK, I live in London, our retirement is 68, okay? If that moves, we probably get a bit unhappy. But in China, 50, 55, you know, life just started at 50. They can easily, you know, expand that. So there's a lot of social polls and also governments encouraging different institutions to use a bit of flexible measure to work with people to retire slightly later, excuse me, to allow the workforce to remain in the labor for long term. So my takeaway on this is strike a very balanced tone from long term and short term. Accommodative policy stay intact, that you should expect and can expect realistically liquidity will get effectively managed down to the systems. And obviously one key question on the next page is consumer power. Will consumer return in China? And a lot of the names holds in our KWEB returns or, you know, associated with those consumer power got to return strongly. In China's many sales festivals really started with a Singles Day, 11/11. One like a symbol, I'm a single, okay, just one person, single. So it's November 11th is a single day sales. For all of you who follows us on the long-term basis, you know that Brandon always send a note, an update on how Singles Day has been done on you know, it's basically a single sales, national sales day on everything you could buy online that will be having huge discounts, include small things like a water bottle to a car, to a television, to anything you can imagine. They will have a huge amount of discounts. This festival is 618 of sales festival. This is really, I think you could correct me, Henry and Brandon. It's really JD counter Alibaba to say you have Singles Day. I will find invented on the festival is 618. But to customer, it's good. You know, always having a discounts. They can load their basket in advance and they can literally buy on the day. And this one is actually not like a Singles Day, it's 1 day sales. This one is a bit longer across a few days. We have some key takeaways given it happened last month. You know, for instance, we use Alibaba and JD because these two platforms pretty much capture majority, if not all, the e-consumer activity happening in China. Also, Pinduoduo also is another name in our fund. Also, you know, the huge bargaining platforms for people to use. But Alibaba, 365 brands sold more than 100 million worth of goods. By the way, that's roughly give or take 13 to 14 billion dollars get sold just in those festival sales. And then of course we have some key takeaways. People is here just read out for you, so at least you know. Don't just read the headline news. This is actually what happened in China, onshore, on the ground, how people are back to normal, back to their own lifestyle. Over 36,000 of brands literally doubled, you know, their sales revenue from their last year's festival. This is on Alibaba. And JD, even more impressive, 83 brands literally sold more than 1 billion RMB. For those counting dollar, that's $140 million worth of goods sold. So just imagine all these transactions happening, all these transaction volumes that, you know, fashion, beauty, sports brands increased over 100% year over year. I think that's hard to call the Chinese consumer is weakening. Weakening doesn't count in those 3-digit numbers. So this is what we see obviously from the numbers. And then when I was there in March and June, what I like to do, which I did anyway, is walking around on the streets to just get a sense yourself to see the most basic stuff, how they look like. I've witnessed, you know, restaurants are full, touristing places are full, people are walking around back to normal. They just chose domestic destination to shop around. And what happened was after my trip, literally Henry wanted a deep-rooted trip to China. He literally not only visited in Beijing, he also visited a couple of other cities in China. We posted a social video, but we have Henry here to tell you how he experienced, what he has seen. Henry, off to you.
Yeah, hi. Thank you, Shaolin. No, it was really a great pleasure. It's been the first time in many years that I've been back in China. I spent almost 3 weeks in Hong Kong and many cities in mainland China. If we go to the next slide, I just have a couple photos from one of the great highlights of my trip was actually visiting Hangzhou, which is, of course, where Alibaba is headquartered. You know, they very graciously allowed us as investors, as representatives of our clients, to come in and tour their offices and meet with key teams. So Firstly, they just announced, so they've always had the major campus in Hangzhou, but they just built a brand new campus right alongside the original campus. And so it's a beautiful campus. It reminded me of Apple's campus in, Infinite Loop, Cupertino, California, with the kind of park in the middle. In Alibaba's case, it's in the shape of the A. And what was remarkable to me was, so in some of the videos I sent to people, and people responded back saying, well, it looks empty. And I said, well, the reason is, and as they told us, is that they have room for 30,000 employees, but they've only got about 10,000 in the new campus. So presumably, I mean, they couldn't give me any direct plans, but presumably they're planning on hiring.
What do you think? They're just shifting people from the old campus into the new, right?
That too. Yeah. But they're definitely want to hire more people. They're definitely looking to, they believe in their growth prospects of their business. I mean, a business that's struggling would not be building this brand new. I mean, absolutely massive campus. And so, we had very interesting meetings, one with their team, Taobao and Tmall team, where they, they showed us some of the highlights from 618, which Shaolin also shared. One of which was they have this Baba VIP, which is the subscription service. So different, it's kind of like Amazon Prime, except interestingly, you can either pay into it, or if you just maintain a certain spend amount, you automatically get all those benefits of the subscription service without paying the monthly fee. So just the fact that they have a significant consumer share of people who are spending, above a certain threshold, which changes, is quite remarkable. So, but going beyond, obviously, we Alibaba's, a big name in KWEB. We like to they're a good example. But going beyond Alibaba, if we move to the next slide, I think. We can look at kind of the internet sector, or rather these growth sectors in China overall, represented in KWEB. So if you look at KWEB compared to, we have 3 other indexes, 2 of them China indexes, MSCI China and FTSE FTSE China 50. KWEB is much more skewed toward these growth sectors: communication services, consumer discretionary, consumer staples, and technology, et cetera. And so that's kind of how you're capturing that growth there. And then if you look at the, the PE obviously kind of lines up being very low at half of what the S&P is in the United States, but also the growth rates, right? The growth rates are significantly higher overall in KWEB, and then within the sectors, obviously we see here consumer staples, consumer discretionary being the highest expected 3-year EPS growth, and then MSCI China is behind KWEB. But similar, because MSCI China is actually not that broad. It's skewed toward the Hong Kong names that many of which are the ones that we own in KWEB. So KWEB is more of a pure exposure to what's going to have the most growth in China. And whereas, you look at FTSE China 50, which is, large cap names across various sectors, really not expected to grow that much right now. So again, not all of China is growing. We can't say that every single sector is, going on powering on all cylinders like in the past, but these, the internet sector, and if we move on to the next slide, you just kind of see this in a different way. That's really where you're getting this growth in China. So if you want to trade into or believe in, that there's going to be some kind of a rebound in China equities, or, a significant consumer growth development, right? We really think that it's these internet names that are going to capture that. So that's what I have. I think it's back to Shaolin.
Yeah. So I think it's a great point. Yeah, don't worry, Aaron.
Thank you, Shaolin.
It's you just think about these slow, low growth sectors like energy, financials, real estate, industrial materials. KWEB has no exposure there. We've got the proverbial good stuff, these growth names that, again, even the southbound connect investors are more biased to. I think one of the biggest pushbacks we've gotten has been the geopolitical, and particularly the strong polling numbers of President Trump. And so we did about a month ago or so, we brought in Terry Branstad, who was President Trump's ambassador to China, who, again, we really recommend listening to to the Terry Branstad interview, or you can simply email us at info@KraneShares.com, and we'll get you the transcript. We did a Q&A write out where Terry really says, you shouldn't be as worried about Trump. Just this will be his second term. It's about his legacy, but he did something that the Biden administration hasn't done, which is he did a deal, and investors seem to be so worried. I mean, about Trump saying 60% tariffs. Well, this is the art of the deal. Don't you remember the distraction technique? 60% tariffs. If you're worried about 60%, you don't sell Chinese equities. You should be shorting Amazon. You should be shorting Walmart and Home Depot and Costco, because 60% tariffs would have a material negative impact on companies that are highly dependent upon China for imports. It would have an incredible effect on the U.S. economy and U.S. inflation. So the 60% tariff thing, like, don't you remember that this is the art of the deal? And the Chinese government will do another deal with Donald Trump. I have no doubt about it. I'm just shocked at this concern of 60% tariffs. Like short U.S. equities, if that's what you're worried about. So again, don't take my word for it. Listen to Donald Trump's appointee, Terry Branstad, about Trump did a deal. He'll want to do another one. And you've actually seen that where Trump's actually talked about allowing Chinese electric vehicle makers build factories in the U.S., right? This is part of Trump's thing. And I think a lot of Chinese companies will be more than willing to build electric vehicles or solar or manufacture in the United States. I think that's more likely to happen under a Trump president. But please use the QR code or simply email us at info@KraneShares. Now, conversely, obviously, we've seen President Biden step aside. It appears at this juncture, Vice President Kamala Harris will take up the mantle as the Democratic contendee. David Edelman, our general counsel, was President Obama's ambassador to Singapore. So we also had the perspective on a Democratic win. Obviously, at the time, we thought it was President Biden would. That's subsequently changed, but we feel that, again, this would be the ability to do a deal with China. There's some willingness there from the China side very clearly. Certainly you could argue Biden's been tougher on China. Part of that was just not to allow an opening for a GOP contender. But potentially we'd see those existing policies modified. So time will tell. But just a absolutely fantastic insight into the two parties from two insiders. But again, I'm most dismissive. I think the Chinese government would lean. I don't think they care who wins, but I think they would potentially lean to a Trump victory. Very out of consensus view, but something we do believe in based on Terry's insights. Now on the next slide, I think for investors for getting exposure into China, we really do have to compare and contrast these two markets: the mainland China, the Chinese A-share, Shanghai and Shenzhen, predominantly owned by domestic investors. Those investors have been quite lukewarm on. They've been adversely affected by falling real estate prices. You see this very, very slow comeback in domestic consumption, which, as Xiaolin pointed out, we think the third plenum and the upcoming Politburo will provide more policy support for domestic consumption. That could help the animal spirits in mainland China, predominantly owned by investors in China. Conversely, we have the KWEB companies, the growth companies listed outside of China in Hong Kong. Those names can be affected by some of the media headlines. Again, ownership is very low in those growth names, very inexpensive from a valuation perspective, as Henry pointed out. So those two markets move very, very differently, and that's why we compare and contrast the KWEB companies versus our Chinese A-share ETFs like KBA or Chin. And so as an investor, you have to think about what do we think is more likely to have more policy support to help the onshore market? That would be kind of a KBA Chin. Or do we see potentially these buybacks, this investment coming out of China, coming into the KWEB companies as we embark on Q2 earnings starting first week of August, right? Potentially, as to Xiaolin's point, 618 numbers look pretty good. Companies have been buying back stock. That should help with net income, earnings per share growth, right? So we think some positives there. But I think another area on the next slide is where we've actually seen, I think, all three of us in going to China, that life seems so normal. I mean, I just can't, from my time in both December, but then even more recently, last month being in Hong Kong and Shenzhen, traffic was terrible, restaurants were crowded, malls were crowded, and very different from the Western, media headlines. And I think what's interesting is like, obviously when I, going to Hong Kong, Shenzhen very close, but Xiaolin and you were up in Beijing, and Dalian, Henry, you went really further afield. You really went local. You went native. But I think that's something that sometimes I've been people have accused me of, well, you're going to these tier 1 cities,
right.
But certainly I think your insights on kind of going into the proverbial hinterlands. Very different, but you saw many of the same things.
Yeah, absolutely. I mean, so, the photos here, just two of the many, just crowds, absolutely crowded spaces that I saw when I was in China. Not included here is Xi'an, obviously the famous terracotta warriors. So our guide there actually told us that, so in 2019, before the pandemic, they had about 2 million visitors to the site. And then last year, they had 10 million. So that's a 5x increase post-pandemic. And even as we know, I mean, at least as I noticed, I don't have that many official statistics on this, but there are fewer foreign visitors. So that's probably in 95% domestic tourism, which is very incredible. And yeah, I mean, these crowds you see, people are out enjoying their time, traveling a lot, traveling less abroad, but traveling more within China. And this is something, and something that my colleagues told me, and people I met in different companies I met kind of told me was, people, we've talked about the savings rate in China. People have money saved up. It's just that right now what they're spending it on is experiences. They're a little bit, the future, they're getting more confident in their future, right? But that takes time to kind of get there again after the pandemic. But really, they're spending on experiences, going out and traveling, dining, everything that kind of I think we saw in the West, right, in 2021 into 2022, coming out of the pandemic, right? That's still kind of the phase they're in China, which is really positive, especially for tourism. We have Trip.com, which doubled its revenues last year, over 100%, I think, revenue growth, which is quite amazing. And Trip.com, by the way, you can't get around in China without it. I mean, it's every train I took, even through the Alipay app, they actually directed me to Trip.com. So anyway, it's just quite incredible, right? So it's going to take time for that to kind of bleed into other consumption areas, but just this kind of people are out there spending on experiences.
Well, I think we've used this idea of like a spending hibernation, that there's a thaw, that it's over springtime, that you have the depressed real estate prices weighing on consumer confidence. You have the scar tissue from the zero COVID. And so the first things you're starting to see are people eating out more often, domestic travel, international travel. So we're heading in that direction. I mean, I know, Xiaolin, you spent some time around the summer Davos, as it's called, but and you touched on Premier Lee's speech, but be kind of curious your take. Obviously you have family up in Harbin, their perspective on where the kind of that consumer confidence in China at the moment.
So Dalian is a northeast city in China. It's not very far from Harbin. So it's one of the 3 famous northern province in China. Okay, Dalian is one and Harbin is the second. Then obviously we walk around a bit on the streets, just to see people around and how business was out. I was literally out walk around nine-ish, so did not sweat full and so on and so forth. And one thing I do like to share is, like, for many of you who dial into our calls knows I always use my dad as an example. Earlier the year that China announced this, like a consumer, like a replacement program. Brandon, you remember this one? If you have old TVs and things like that, you want to come in and trade in for a new one, more effective one, a new version, the government will subsidize, okay? And then literally what I was having a conversation with my father was, summer was really hot in Harbin, strangely enough. Harbin is a city that winter can be minus 30, 40 degree, and summer would be the other way around, flip it, okay? 30 degree, 35 degree in summer. I think that's your 80, 90 Fahrenheit. I could get it wrong, okay? And then he was like, he used an air conditioner for many years. Now he trade in, he got new one. And then he says government subsidize 20%. And then the merchants are giving a bit sales. So he's looking at things that he wants to replace, even to buy. And that's not him just alone. A lot of people, I mean, I use my dad, this is the age that, love bargains, and then they will start to buy. And then the true underlying customer are buying. Okay, and then this is really good to see. And the other things, like when I was in Beijing visiting CSRC, we had a meeting with CSRC's new chairman. John and I both won, and then it was fascinating. We visited a temple, just a temple on the street, by the street. We walk in and it's just like not giant, massive, big ones. But then we go in, is lined up buying tickets, and we ask the guy, is this the peak hour? The guy says every hour is like this. We have to how many people can go in. I said, how many people can go in then? He says per hour, 5,000. And then every day they have to restrict to 40,000 people at the most. And I was like, well, I don't believe this. It's many people inside. So for many of you know John Crane, who's our CEO, 6'7", like a giant tall person. I'm not a tall person, but I go in with him, and you're not allowed to have a bag. So we were kind of, okay, put my phone in your pocket, John. And we walk in. And I tell you, we walk around a bit, 2 minutes later, I lost John. It was first ever. I never thought I could lose a giant tall guy in China, an American, and I couldn't find him. And only after an hour, we finally united with each other. But just to say that tourists are picking up in China, just like Henry hit the point, it's just not many foreigners has returned. So we don't feel that way, or we don't see it that way. But domestically, people are traveling, life are normal. They are carrying on with what they have. And then I think we're going to the Q&A. I see some questions from our friend Simon. I'm going to address some of your questions. And one of them was like a consumer. Simon, Chinese consumer has no issue with liquidity. Their saving rate is double digits year over year, okay? And the issue is really how we're going to make them feel more comfortable and confident to spend. Today, with a lot of these programs happening, people are definitely feeling more comfortable and confident to spend. And clearly, they would use that as an opportunity, to see a bargain and trigger them to continue to spend. So I just pause there, Brandon. I just want to say that from summer Davos, I attended the public session, but public is also selected audience. A couple of hundreds was there to listen to Premier Lee's speech. John had his private dialogue, that's closed door conversations with Premier Lee. It's really just 10, 15 multinational CEOs was in the room, and including John. They're there, and his message couldn't be more clear. It is China is open for international business, okay? Premier Lee stayed for an hour to talk to these 10, 15 people to tell them how China will make the policy more accommodative, how they're going to welcome foreign investments to come to China, how they're going to make sure the environment framework is very pro working together. So I'm very encouraging to see a lot of the interaction and also the exchange of different views happening in China. Brendan.
Yeah, and certainly, just yesterday, the U.S. China Business Council is in Beijing, and I'm pretty sure it was Beijing, maybe in Shanghai, but I was able to meet with Premier Lee. That was that delegation of U.S. Corporations and corporate executives was led by FedEx's CEO and chairman, who obviously their business is highly geared to China. And I think it's U.S. corporations have done so well in China, and I think particularly around you've seen candidate Trump align himself with entrepreneurs like Elon Musk, who have huge, significant revenue weights for Tesla in China. I think you're going to get that, counsel from someone like Elon Musk, or Jamie Dimon's name's been thrown out there. As a potential Treasury Secretary, certainly I don't think he's going to be advocating tariffs. So I'm just, yeah, I mean, it's great media clickbait fodder, but I'm very skeptical of this 60% tariff. And again, if based on the very low underweight to Chinese equities, again, you should be really worried about U.S. stocks. So yeah, certainly a lot of questions coming in. I mean, it's
I think Simon also asked about the Alibaba becoming dual primary listed in Hong Kong and going to southbound, and I think he said, we mentioned the 44 billion, so that's the current ownership of Tencent.
Yeah.
So Tencent actually has a larger market cap than Alibaba, so that would be on the very high end of potential for inflows to Alibaba.
Yeah. I mean, I think
right,
for sure,
so.
it's we're not saying, but certainly using the almost 10% ownership, with Alibaba's market cap, it's just about 200 billion. That's a real number. At the same time, I don't think you can dismiss the $40 billion number just from the number of users and their ability to buy such a incredible franchise stock for the very first time. And again, that the key is that won't happen overnight. It will happen, and ultimately this is a new buyer coming into the stock. And I know we've started reaching out to some of the other companies within KWEB saying, hey, why aren't you thinking about moving your primary listing? Why aren't you trying to get into southbound Stock Connect? So just as Alibaba was the first to relist in Hong Kong, we certainly think we'll see a lot of others. Obviously, Tencent and Meituan primary listing has always been in Hong Kong. So yeah, certainly a real catalyst there.
Sorry, Henry, go ahead, please.
Oh yeah, I was just gonna say there's another question about the buybacks. How much of the buybacks are driven by policy, right? I mean, we had the 9 measures, right, encouraging companies to do buybacks, but I think the companies themselves also make this decision, right? And
yeah, I think we've seen, I mean, if you think about the secret sauce for Japan shaking itself out of a really 30-year bear market, was you had a significant purchasing of equity ETFs in Japan by the Bank of Japan, who literally owns the Japanese ETF industry today, or is there, basically is the only shareholder. You then had them basically pushing these corporate reforms, and that included buybacks and paying back dividends. But you're seeing arguably a very similar scenario play out in China today, that the estimates are upward of 50 billion of net buying of mainland China ETFs by government related entities. You also have, I think more geared to mainland China, more of this pushing corporate, amongst the SOEs, the state-owned enterprises, paying dividends, doing buybacks, not allowing insider selling from both an individual as a corporate, and implementing ESOP plans for SOEs. And in the KWEB companies, these are private companies. We don't think that's government interference. We think that simply entrepreneur owners saying our stocks are really cheap. Meituan just started its first buyback. That never bought back stock ever. Just started a little more than a month and a half ago. Alibaba, first dividend ever in December of last year. Actually going to pay out $1.64 in 2024. Tencent, very voracious buyback program. Certainly spun off their positions for free to shareholders in both JD and Meituan. Just really strong. So we think 2 different motivations there, but again, real catalysts.
Agree. You know, like the SoftBank Connect, it is important, Simon, to answer your question. Because you know, Brandon, we probably should highlight that for the stocks, at least it is not on the Connect program. You need to apply, you need to open an account, you need a QD quota to buy that stock. Even though, use Alibaba as an example, even though the domestic customer in China using Alibaba platform every day contribute to their growth and revenue, they cannot buy the stock. And once they are eligible on the Stock Connect, they literally can buy the stock just freely, as if they lease it in mainland. So that's a huge opening for domestic investor to be able to buy the stocks. They've been contributing to the growth, but they not be able to buy the stock for a long time, but now they can. That's one. Second, in China, insurance is a big buyer, okay, big buyer of stock market, and they wouldn't buy any stocks. It's QD, or that's qualified direct investments. It's called QD. It's a quota. But once it's on Connect, that's actually opened up for insurance to buy. That's a huge chunk of insurance buying. Obviously, both institutional and retail be able to buy that. So just answer that, Sam is asking how material Connect's stock is actually quite material in both institutional and retail space. And then there are some questions in here asking about, you know, using Baba as an example of their earnings and potential, so on and so forth. We had the pleasure to meet and get to know Ali's international, or you interviewed him, Brandon, at our International Investment Forum in Milan. This is Baba's, you know, general manager that is for Alibaba's international business. Since we got to know him for 2 or 3 years already, I always keep an eye on their international business, because all of these companies, e-commerce included, are trying very hard to internationalize their business, period, the end, okay? Domestic, they have single high digits returns year-over-year, quarter-over-quarter, which is great results, and they all international, including Pinduoduo, Tmall, you use them in US. So Baba's 3 quarters ago, international business is 55% year-over-year. And the quarter before last was 40, and the last quarter was 66. And these are easily get covered by some sort of headlines, but fundamentally, they're definitely gaining their ground and growing very strongly and solidly. And I give you another example. Not only international business is really doing well, that we keep an eye on that double digits. That double digits is really high double digits. And then in March, when I go to China and Asia trip, shall I say, I was there for nearly 2 weeks. I also went to Vietnam. So one corporate I met is Lazard. Lazard is the logistic company of Alibaba. They almost building Lazard like Amazon in Southeast Asia. Okay, so the headquarters in Vietnam, in Ho Chi Minh City. I met with their GM, general manager. They gave us a walk through the business, financial statement. I walked around their warehouse, you know, distribution center, so on and so forth, fully automated. By the way, it's super hot. Okay, it's like 39 degrees, like Kelly. But I walk in the factory, there's no air conditioning, by the way, okay? So it was quite a hard experience. But they were showing us how their business managed, how they use one hub for distribute for everything within 24 hours. It was effective, efficient. I was super surprised and impressed. Then I asked the question, remember the 1+N that they're going to, you know, IPO all the sub business. I said, when are you going to IPO? The guy was looking at me, listen, our parent company of Alibaba get treated unfairly valued. That's his words, not mine. Fairly, you know, very unfairly valued. Why would we go public? We are ready anytime. We just chose the moment to press the button. The reason I share this with you is this is not in public. This is not broadly broadcast and shared in the market pressing nothing for that news. And those are one of the key news that, you know, the 1+N, the N's are ready. They're just choosing their moment to go to their ends. So this is what I want to share with you, to say the least.
Yeah, I think, you know, we know the domestic consumption in China, it's slowly, you know, we talk about this incremental rebound, these green shoots we're seeing. So I think our expectations going in the earnings season, which again starts in just a week and a half. I mean, next week we'll start getting the Politburo meeting and the potential for actual policies. You know, the point of the third plenum is this big picture. You know, the Politburo meetings where we start really getting the specifics. But I think going into earnings season, you know, top line growth is probably not going to be double digit. You know, it's probably going to be muted because of this slow domestic rebound. At the same time, you have intense competition, particularly in e-commerce from ByteDance in China. But it's really the bottom line where we think within this earnings per share, where we think investors are potentially underestimating. I mean, for the 618 event, there's a lot of discounting. So that might put some pressure on margins. You know, we would agree. And that might, but again, it's really that EPS growth we think investors should be really focused on. Again, expectations top line, you know, we're keeping them, you know, muted. But again, I think it's against this backdrop of such low ownership. I mean, it's that's part of what I see is just any sort of upsized surprise, you know, would, you know, put a lot of potential pressure on short sellers or just kind of surprise people to then obviously that under allocation for managers, you know, then they'd have to chase that.
Yeah. Got a question about A-shares catalyst too. I think, I mean, this is an important, I think a lot of A-share companies report semi-annually, right? So I think this is an important earnings season for A-shares too. I think that's an important, maybe even more so.
Yeah, I think that's a great point and great question. You know, I think similarly we see some of the corporate governance improvements helping. You know, they're a little bit earlier in that cycle, but certainly we think the elements of China's economy where that export-driven manufacturing, if you look at that, you know, it's been so strong. To Xiao Lin's point, you know, Q1 earnings handedly beat expectations. Q2 was, you know, okay, and but certainly it shows demand for Chinese goods is still very, very strong. So those export-driven geared manufacturers and industries arguably are going to be big beneficiaries. Certainly the, you know, more domestic geared companies potentially a little bit more muted impact, but the expectations are pretty low going into that earnings season as well.
Brandon, one great question was on the wealth effect from property to equities. I think this is worth to point out is probably 5 years ago, a few years ago, you would see Chinese household of their financial assets, 80-90% is in real estate. Today is probably about somewhere 60. I think 60 is a fair value, is where they are at. Just to answer this question. So they have already been shifted away from property markets already happening. That's already happening over the last few years. You could call it market correction, but I think it's more proactively of shifted away from real estate than passively waiting for property correct. And then also there's a huge increase in equity, not only individually buying broad equity, broader ETF, ETF, they also have a bit of an institution player come in, your pensions become more equity focused, then so on and so forth. So definitely that is definitely happening. Obviously with the valuation, like I always say, you know, before this buyback comes back, I always say, Brandon, if the growth is good, your valuation is very cheap, why don't you buy your own stock? And then it seems this company hurt us, you know, we are buying our own stocks. So of course the valuation is there, the growth, the earnings, obviously we see huge improvement, internationalizing start to materialize. So we think this is happening already of the shift of the wealth effect from property to equities, and there's more way to go. If you use 60 of property compared to US, you know, this is still another at least 52% to go, I'd say, from here. Would you say that?
Yeah. It's I saw some data recently that, you know, I think US equities are almost 2/3 of US household wealth. You know, Japan is about half that, but China is probably 1/5 of that, you know, down, you know, maybe down 3 to 5% in equities or mutual funds. So yeah, it's, you know, just a small change in behavior there. And I think that also brings up, Jalen, you know, why we think you see more policies. Yeah, they're trying to balance. They don't want to re-incentivize this speculation in real estate, you know, this national pastime of investing in real estate in China. But they also need to kind of make sure prices stabilize and kind of improve. So they're weighing a fine line there. But certainly, yeah, we think particularly that lackluster performance in mainland Shanghai, Shenzhen, it's it's at a critical juncture, as we spoke about in today's China last night, and certainly I think you're going to see some more catalysts coming out of the Politburo meeting, as well as just because of where we are, where you're having that local stock market. It really is telling the government you got to step on the gas pedal with stimulus policies.
I agree. I think, Brandon, you do agree. I think investor will agree is when you assess will the policymakers stay on top of everything, so satisfies what we as an investor require. You guys, that question you got to answer by for them, do they care? And then I think I saw one of the questions, I can't find them anymore. I want to say the short answer is yes. And why I say that, I give you an example, is in March when John and I visited Beijing. Late March, we visit Beijing. We want to see CSRC. For those of you, CSRC is equivalent of SEC in the United States, is Chinese regulator. So they regulate the financial market, capital market, everything that's financial related. They have a new appointed chairman, Mr. Wu. We got to know him before he was appointed to the role in the past life. So really, we want to see him, just want to catch up, okay, just see everything and how things are going. He was in the job for less than a month, and then we really went there and see. John and I was there. 5 of the senior people were sitting opposite us. The very first question they asked John and I was, how can I help? How can I help the investor? We use this repeatedly. It's like, I'm a Chinese, okay? I was born in China, I speak Chinese, and then the first thing you do is, in the past, a couple of things. You got to sense the leadership. You don't say the wrong things, and they probably don't even speak English. You need a translator. You were so frustrated, and then the translator will translate them in the massaging way, make everything feel good. You were really angry, and they were slightly concerned. There's always miscommunication. This leadership speak perfect English. They work in the international organization before. They understand us. We brought in a translator. We didn't need it whatsoever. We have back and forth conversation, and the guy opens up the conversation. I test them in Chinese. I did, okay, just for the sake of, I know how honest can we be. I said, how honest do you want? And he said, bring them on. I said, okay, get ready. So we were like, get ready. Then I told them, we were not happy, we're pissed. I can't use the word because I get banned by my compliance officer. Okay, I use the very rude word. I said, market didn't understand what you're trying to do during pandemic. You completely up, and then now you got to repair their confidence, and they are all into it. Okay, they were saying we do that for the sake of da-di-da, but they were not defending, they were not being offended or whatsoever. They were saying we will do whatever it takes to repair this confidence and repair these sentiments. Now and then I obviously asked what we can do. I said, keep transparent and communicative. If you introduce regulations, so on and so forth, it's nothing bad. If you, for the good sake of the market, investor can understand, trust us, we have the ability to understand it. You just need to tell us what you're trying to do. And I think March, the Chinese regulator introduced quite a lot of regulations. Henry mentioned one, the 9 measures and this and that. Market didn't sell off. Why? They were very clear. We are dealing with this. We are trying to clean up the IPO market. Some of the unhealthy companies shouldn't come IPO, da-di-da-di-da. They were very clear. All these regulations introduced in the last few months is not less, but market didn't bother because the transparency, because the communicative. So I give a credit to this leadership, that they understand our needs. They are obviously very committed to repair the confidence and sentiments. Fundamental is improving. Of that gave us slightly the confidence to say, you know what, we could literally have a slightly, expectations to say, we could potentially do better. You can do market-oriented, market-friendly policy from here. Some question was asked, will we expect any policy off after this 3rd plenary meeting? The answer is the opposite. You're going to see consistency and persistency of all the easing measures continue to be in place. I'm waiting for more physical spending. I think that should come in a big way. So if nothing but continue a full speed ahead of accommodating.
Yeah. So we've seen the interest rate cuts.
Yep.
After the 3rd plenum from the PBOC earlier this week, and I agree. I think you'll see more fiscal stimulus coming, and certainly at the same time, I think you'll see continued policy adjustment to support the market. The stock market is a barometer for public opinion, and I think where the market is at this juncture requires it requires stepping on the proverbial gas pedal. So yeah, I think certainly again, if you want that Terry Branstad webinar or Q&A, please email us at info@KraneShares. But yeah, I think yeah, we're just about at the hour and 15 mark. But
I have one plug in because
Sure.
every year in this early autumn time, September, October, this year is October the 9th. We're going to host this international, investor forum that we have physical events hosted by KraneShares. This time is in London. That Brandon will be here in person. I'll be there, and joined by a few of my other colleagues. We're getting corporates here. We're going to get an EV company here, and some e-commerce company name here, corporates. We'd love to have any of you who happen to be in London join us on the day. That's 9th of October in London. And if you need any of the events registration, get in touch with us. It's info@KraneShares.com. It's hosted in London. So for London investors, UK investors, we probably will reach out to you in the coming days for invitation, save the date. But for the rest of you, if you want to join, we also try to have a live stream for the session. It's going to be 4 hours. If you can choose the session, you dial in. But Brandon will be here, I'll be here, and we have Crane will be here, John Crane, and a few of my other colleagues and external speakers. You're going to enjoy the session. If you are interested, let us know.
And then of course, if one would like the presentation from today, please email us also at info@KraneShares.com. But yeah, thank you so much. Great job, Shaolin. Great job, Henry.
Thank you, Brandon.